think, act, and prosper. You are now tuned into the Money Level Show.
Hey everyone, welcome back to the Money Level Show, where we think, act, and prosper. Today, we're going to talk about what is quantitative tightening and how this plays into the market. Now, personally, I believe that once the Fed starts quantitative tightening, the market is going to take a deeper dive down, especially risk assets, because they are risk assets for a reason. They are used to thriving when monetary policy is very loose and very accommodative towards the economy. And now we're seeing that the Fed is actually pulling some of that money back. They're actually tightening and going to be selling some bonds off of their balance sheet. And so we're going to look at what this looks like. So the Fed is scheduled to start quantitative tightening in June. And so I want to give you all this heads up because the market may get ugly. All right. It may get ugly. Now, quantitative tightening is when the Fed starts selling bonds and selling securities off of their balance sheet. So the Fed, when they're easing, they buy these securities, they put it on their balance sheet. This is also known as money printing, and it's not actually money printing, but they do go into a system, create money out of thin air, and they buy these bonds from the government. They also buy mortgage-backed securities or whatnot, and so they actually increase their balance sheet. Now, that is when they're quantitative easing. Now, when they're tightening, they're selling those assets off their balance sheet, and they are saying that the economy is strong and that they will actually start reducing their balance sheet and that the economy can hold its own by itself, pretty much. So that is pretty much how the Fed operates in some ways. So let's go ahead and dive into this. So here we're looking at the Fed's balance sheet. As you can see, it was relatively flat for a lot of years, and then 2008, what happens? We have the global financial crisis. The Fed has to start buying up, these assets and increasing their balance sheet to support the markets and to support the economy. And so, as you can see, it spikes up. So this is in millions of dollars, but it's actually trillions when you look on here. So this went from 898 billion to about 2.25 trillion. And then you begin to see the different QEs actually come into play. So they did 3 rounds of QE. You can see that the balance sheet continues to increase. And then Jerome Powell gets in office around 2017, 2018. He comes in very hawkish, saying that, okay, it's time to tighten. It's time to raise interest rates and tighten. So what you look at is you see that it starts to go down. Something breaks in the market. So a lot of people talk about this. Lynn Alden talks about the Fed will tighten until something breaks. And then at this point, this was the repo market, which is a market where you have these banks and lenders. They lend money to each other. I think hedge funds may be in there too, but they lend money to each other back and forth at an overnight interest rate. And it's meant to have liquidity. So we saw the repo market actually spike in 2019. And so the Fed had to reverse course. They had to reverse course at the end of 2019 to support the repo market. And stocks took a big hit during this time when the Fed started tightening. So I'm expecting the same thing now. I mean, we're already seeing it now with the Fed raising interest rates. So a lot of people are actually going risk off. They're going into cash, gold, and other places just to be more protective. So now when we look at the repo market, this is the United States overnight repo rate. As you can see, before 2020, this is 2019, the repo market rate spiked. So the Fed wanted to start tightening. Powell came in, we saw a spike here, but then it just spiked close to 10%. I think it was actually higher than this overnight. And that pretty much signaled that the Fed needed to reverse course. And so they had to come in and change their policy. So then you see when the pandemic starts, the Fed increases their balance sheet dramatically. And that is when they started buying more bonds and financing debt and financing stimulus and all these different things. And so they had to finance the government's spending, right? So that's how that worked. Now, when the Fed has interest rates, right? We've looked at this before. I've showed this to you all. But the interest rates, for example, interest rates, were low. This was they bottomed in about 2015. Then they started increasing them again. And, 2018, Powell comes in, he's actually increasing the rates even more, being more hawkish. And then you start to see them cut rates after the repo spike. 2000, I think it was September 2019, the repo spiked, and then they cut rates. And then February 2020, what happens? The pandemic, they cut rates again, and now they're actually increasing them again. And so, and they haven't even increased them a lot, and the market's panicking. So I just think it's going to get bad if they do some big increases like this, because I know from 2018 to 2019, the market took a big hit, which we'll look at that in a minute. So this is from the St. Louis Fed. What is quantitative tightening? Several years ago, the term quantitative easing was a commonplace in discussions about the Federal Reserve and monetary policy. More recently, you might have heard the term quantitative tightening. What do quantitative easing and tightening mean? Quantitative easing, or QE, refers to policies that substantially expand the size of the Fed's balance sheet. Quantitative tightening, or QT, refers to the opposite, policies that reduce the size of the Fed's balance sheet. So the Fed themselves explains it. Now, they talk a little bit in here about does QT do the opposite of QE, and they're saying it doesn't and all this stuff. But the Fed is in denial about a lot of things, especially Powell. He's coming out and they're saying that the economy is strong. I mean, the economy isn't really that strong when you're seeing inflation this high. A lot of people are hurting, rents are raising. I know people that are in, housing crisis situations. I mean, homeless population's increasing. It's just the economy is not looking good. I mean, they're saying because the job market, I think there's two jobs per unemployed or something like that. So each person has 2 job opportunities ahead of them or whatnot, or available to them. And so they're looking at stuff like that, but the economy isn't looking good. So the Fed is going to start tightening into a global slowdown, and we're seeing that the use of credit is going up. We're seeing that people are relying more on credit cards and whatnot, and so this is looking pretty grim, y'all. So now look at the NASDAQ. The NASDAQ, it starts climbing and stuff. Okay, 2018. It's climbing, it's doing this thing, right? Then it just takes a big dive. I mean, it goes down to 6,332. It might have been lower than this. It may have just closed there, but it was pretty much back here in 2017. And this is when the Fed started tightening, and you see that the NASDAQ just plummeted, right? Then they reverse course, right? And then you start seeing the NASDAQ actually going up even more. Then, the pandemic comes, and pretty much the NASDAQ plummets again. Then you see that the Fed actually starts increasing their balance sheet, buying bonds, mortgage-backed securities, cutting interest rates. And you see the NASDAQ start to go up even more, right? And this stuff correlates a lot, you all. So I want you all to be aware of this. And then, you get, December 21, the Fed came out kind of hawkish. This stuff, topped in November 21. The Fed came out, they're going to raise interest rates. A lot of people didn't believe it was going to hurt the markets, or Bitcoin was invincible, all these different things. And then Fed comes out hawkish, NASDAQ takes a big hit. It pops back up. You also have Russia, Ukraine in here. It pops back up. The Fed raises their rates twice. And then you see that the NASDAQ has just been rolling over. So I don't know how far this is going to go down. All I know is that, if you're in a lot of risk assets, you are definitely going to be hurting, when you look at these types of cycles, these tightening cycles or whatnot. And so for me, I invest in individual companies. However, I know that my portfolio isn't invincible. I know that it is hedged because pretty much I mean, oil prices aren't going down. And so I have a lot of stocks and commodities and stuff. I know that we're in a commodity super cycle, but I could see some more downside. I have seen some downside this year, just not to the same degree as a lot of other people that were betting on Netflix to go up forever and thinking that these stocks are just going to go up forever. That's not the case. And so I do believe for this decade, we are in a commodity super cycle. I do believe that these commodities that are under invested in are going to skyrocket. They're going to go higher. And so that is why I am positioned there. However, I do believe that I could see some more downside as people may sell those stocks to cover some of their losses on, in their risk assets, or their, Bitcoin goes down. So they need to cover, or they may need some liquidity because their portfolio lost like 20, 30, 40% or whatnot. So I believe that it's going to get worse. And I'm just trying to be ready and be wise during this time. I am in a lot of stocks that pay dividends or whatnot, but I think that, I'm going to do some portfolio restructuring at some point just to be a little more hedged in the coming month, couple of months until the Fed reverses course. So that's where I'm at. And I just hope this information is helpful to you all, and be sure to hit the like button, the subscribe, and I hope that you all have a blessed day. All right, peace.